Hello everyone, and welcome back to Explain the Charts. Today is October 23rd, 2025, and we are taking a close look at Amazon, ticker symbol Amazon. We're going to break down the recent news that's been shaking things up and then dive deep into the charts to see what the technicals are telling us. The biggest headline this week was the major AWS outage that occurred on Monday, October 20th. This event caused significant disruptions across the internet and initially sparked a wave of bearish sentiment among retail traders on platforms like StockTwits. Interestingly, despite the outage and the initial fear, the stock itself has shown resilience, even gaining ground in the following sessions. This highlights a disconnect between the short-term operational news and the market's broader valuation of the company. It's important to remember the context here. Amazon has been the laggard of the Magnificent Seven stocks this year, struggling to make significant gains. Many analysts believe the market is looking past this temporary outage and focusing intently on the upcoming third-quarter earnings report, scheduled for October 30th. The real story for investors is whether Amazon can re-accelerate AWS growth and solidify its position in the competitive AI landscape. There's a lot of optimism from analysts surrounding initiatives like Project Rainier and key partnerships, with some predicting AWS growth could return to the 20% range, which would be a major inflection point. So we have this fascinating mix of a short-term crisis against a long-term, high-stakes growth story. Now let's turn to the daily chart to get the big picture on the price action. Looking at the chart since last year, we can see a powerful rally that started in early November 2024 and peaked in late January of this year, right around the $242 level. Since hitting that peak, Amazon has been in a clear downtrend, characterized by a series of lower highs and lower lows. There was a particularly sharp drop in early April, where the price found a bottom near $166 before staging a recovery. That recovery pushed the stock back up towards the $230s over the summer, but it failed to surpass the previous all-time high. This failure established a very strong and significant resistance zone between $235 and $242. Following that rejection, we saw another downward move, with the price eventually finding support in the low $210s just this month. Notice the large red candle on October 10th, a drop of over 4%, which established a recent low for the stock at $216. Since that low, the price has been in a period of consolidation. What's most telling is that the negative AWS outage news failed to break this support level. In fact, we saw buyers step in and defend it. The last closing price was $217.95, hovering just above this critical area. So, the key support level to watch is without a doubt that $216 low from October 10th. If the price breaks below that level, it would be a very bearish signal in the short term, potentially opening the door for a slide towards the $200 psychological mark. On the upside, immediate resistance sits in the $223 to $225 range, an area that has capped several recent rally attempts. The more significant resistance to overcome for a true trend reversal would be the high from September, up around $238. Let's zoom in on the daily chart to get a better look at this month's price action. I'll filter the chart to show everything from October 1st onwards. Here you can see that sharp sell-off on October 10th much more clearly, followed by several days of tight, indecisive trading. Now, look at the candle for Monday, October 20th, the day of the AWS outage. It was a green candle. It opened lower but closed significantly higher, which tells us that buyers absorbed the selling pressure and saw the dip as an opportunity. Tuesday, October 21st, showed strong bullish follow-through, with the price pushing all the way up to $222. However, yesterday, October 22nd, we saw a pullback with a close at $217.95. This formed a bearish engulfing pattern, which is typically a reversal signal, but it occurred on lower volume than the prior day's rally, which somewhat weakens its bearish implication. This price action strongly suggests that the market has largely shrugged off the outage and is now in a holding pattern ahead of earnings. The current battleground is clearly defined between the $216 support and the $223 resistance. To understand the intraday dynamics better, let's switch over to the 1-hour chart and look at the last week of trading. Here, the gap down on October 10th is very prominent. After the gap, you can see the price established a clear intraday support base around the $213 to $214 area before it started to bounce back. Throughout Monday, October 20th, during the outage, the price action held up remarkably well. The significant move higher occurred on Tuesday the 21st, breaking through several minor resistance levels with conviction. Yesterday's pullback on the 22nd is also very clear, finding some initial support near the $218 mark where it's currently hovering. This $218 level is now a key short-term pivot point. If bulls can defend this level, we could see another attempt to break the $223 resistance. However, if $218 fails to hold, a retest of those crucial $216 lows becomes extremely likely. The price is effectively trapped in a range between yesterday's highs around $220 and the lows around $216.50. Finally, let's drill down to the 15-minute chart for the last couple of days to analyze the most recent action. We can see the strong uptrend from Tuesday being decisively rejected near that $223 level. The subsequent sell-off yesterday afternoon was quite sharp, breaking below the $220 support level with ease. The price action for the rest of the session shows a market struggling to find direction, essentially moving sideways. This short-term chart confirms the indecision we're seeing on the higher time frames. Traders are clearly hesitant to make any large commitments right now as they await the next major catalyst. That catalyst is, without a doubt, the earnings report on October 30th. All right, let's go back to the daily chart to wrap everything up. Here's the summary and potential scenarios. For the bullish case, the fact that the market absorbed the negative AWS news is a sign of underlying strength. If the stock can continue to hold the $216 support and decisively break above the $223 to $225 resistance zone, the path towards the September highs around $238 is open. The primary catalyst for this move would have to be a strong earnings report on October 30th, specifically showing that AWS growth is reaccelerating. If earnings are positive, I would place the probability of a move towards $230 or higher before the end of the year at around 60%. Now for the bearish case, we can't ignore that the stock is still in a longer-term downtrend from its January highs. This recent bounce could be a temporary reprieve before the next leg down. If the price breaks below the critical $216 support, the next major target becomes the psychological $200 level. A significant earnings miss or weak forward guidance, especially for AWS, would validate this bearish trend. If earnings are a disappointment, the probability of seeing sub-$200 prices increases to around 40%. So, to recap the key levels you need to watch, support is at $216, then $200. Resistance is at the $223 to $225 zone, and then the major hurdle at $238. Keep a close eye on trading volume. A breakout or breakdown on high volume will be more significant. Ultimately, all eyes are on the October 30th earnings call. The guidance given for AWS growth will likely determine the direction of this stock for the remainder of the year. Please remember, this analysis is for informational and educational purposes only and should not be considered financial advice. Always conduct your own research and consult with a professional financial advisor before making any investment decisions. Thanks for watching Explain the Charts, and don't forget to like and subscribe for more in-depth analysis.